Welcome to Market Newsroom. Today, we are examining a $1.45 trillion warning hiding inside the United States Treasury market. The Treasury Borrowing Advisory Committee, a group of senior bond dealers and investors advising the government, warned of a $1.45 trillion funding shortfall for fiscal 2027 and 2028. The estimate assumes current Treasury auction sizes continue. This does not mean the government has already missed a payment or failed to borrow. It means the existing schedule for selling debt may not raise enough cash to meet projected financing needs during those future fiscal years. The Treasury does not borrow all the government's annual cash in one transaction. It repeatedly auctions bills, notes, and bonds to investors. Current financial management has helped handle a federal deficit of about $2 trillion, but it has not removed the underlying borrowing need. If revenue does not grow enough and spending is not reduced, future auctions must raise more money. The gap appears because the present auction schedule may be too small for those projected deficits. The warning creates a split market backdrop instead of one simple reaction. Weak jobs data has encouraged hopes for lower Federal Reserve rates, which can support equities and rate-sensitive assets in the short run. The Treasury gap points in the opposite direction for longer-term bonds. If investors expect much more government debt, they may demand higher yields before buying it. That means stocks can respond positively to rate cut hopes, while long-duration bonds remain vulnerable to future debt supply. The main risk is that larger Treasury auctions arrive without enough additional demand. Yields may then need to rise to persuade investors to buy the debt. The government would also compete with private borrowers, including technology companies financing major infrastructure. Higher long-term yields can spread through the economy by increasing financing costs for real estate, public infrastructure, and businesses. If inflation remains persistent, attracting buyers could become harder because investors would want greater compensation for holding long-term fixed-rate debt. Investors should watch Treasury auction results for signs that demand is weakening. Strong participation would show that buyers can absorb additional supply without a major increase in yields. Weak demand would make the warning more urgent. Also monitor whether the Treasury increases auction sizes, whether deficits narrow through revenue or spending changes, and how long-term yields behave compared with short-term rates. The central question is simple. Can the market finance future government borrowing at acceptable costs without disrupting other investments? That is today's Market Deep Dive. Subscribe to Market Newsroom for more clear, investor-focused analysis.